Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host. Thank you for tuning in. If you have not already, be sure to subscribe. Hit that button on YouTube, SoundCloud, or BitChute, whatever the platform of your choice may be. We are honored today to have Campbell Harvey, finance professor at Duke University and a strategy advisor to the Man Group. He is one of the most prominent financial academics around, and this is what I particularly appreciate about his work. I've been following him on LinkedIn, where he has a large following, and he's not afraid to jump into the popular fray, which is particularly maybe unique almost in this era of academics. So he has written with his Man Group colleagues an article which is going crazy on it's a research piece available on SSRN. We'll include the link in the show notes. Quote, or the title is "The Best Strategies for Inflationary Times." And so, Cam, welcome to the show. And please tell us, do you subscribe to the view that the elevated inflation we are experiencing now in the United States is, quote, transitory, as the Federal Reserve Board has proposed?
Well, first, thanks for having me on the show. Second, my paper is about the behavior of different asset classes and dynamic strategies during inflationary times. The question that you're asking is a very important question in terms of the impact of inflation on asset prices, because asset prices don't really respond to very short-term things like, for example, a pipeline is hijacked and the price of gasoline goes up in the very short term, causing some inflation, but everybody knows that that'll be reversed. And equities and long-term bonds, those are long-lived assets. And what counts for them is the longer term or more permanent inflation. And now to your question. So the debate is whether the 5% year-over-year read that we have right now, is that permanent or transitory? And the answer to me is pretty obvious, that there's components of both. So I think it's a big mistake to brush this off as a transitory episode. Sure, we can look at lumber prices up 400%. There's going to be some mean reversion, obviously. Used cars, there'll be some mean reversion. But what you need to do is to go component by component and figure out what will revert to the mean, what will revert to something higher than the mean, or what is structural. And the thing that I point to as kind of the most obvious is housing. Housing is 32% of the CPI. And if you look in the most recent release, that is running at about 2% year over year. Now, that doesn't really square with what's actually happening in terms of rentals and housing prices. And you just need to look at the Case-Shiller index to realize that what's being reported in the CPI is not representative of what's actually happening in the housing market. Indeed, Fannie Mae put out a very interesting study showing that there's a lag between the Case-Shiller housing price index and what happens to be reflected in the CPI. And that lag is surprisingly long. It's 5 quarters. So for me, if you brush off inflation as transitory, you're making a big mistake, but I totally understand what the Fed is doing. The Fed is trying to brush this off. It's transitory. It's no big deal because they don't want this disastrous scenario for them. And that is this idea of kind of self-fulfilling expectations. So if people believe that inflation is permanently higher. So we go from 2% to 4%. That causes a change of behavior that creates the self-fulfilling prophecy. So they'll do whatever they can to talk it down. For me, I don't have a political agenda. I look at the data, and you ask my opinion, you got it.
Okay. Right. And actually, real estate is a great example to point to, because I've recently written about what's going on in Canada, and they have had a year-over-year median sell price, which is up 30 to 40%. It's out of control. So as you say, there are challenges with the CPI, how we accommodate all these elements. And it is true too, asking, are we or are we not, is a little bit misleading, because of course, some things will go back, some things will not. The big challenge you point to is that if there are changed expectations in the long run, that is serious. And maybe we have that, maybe we don't, but it seems probable. Regardless, the research you have done, as you said, is really agnostic to this situation. It is looking back at the past century in the US, UK, and Japan, and just saying which asset classes performed better when there was inflation, right? So we don't have to speculate about the future. We're just saying, what were the strategies, and did these strategies change over time? As in, did people actually learn from what happened, let's say, through the lead up to the Great Depression or the 70s, and then adjust so that the strategies changed over time? Or were there consistent themes that just stuck throughout the century?
So one thing that we don't do in our paper is to look at the average performance of various different asset classes and strategies in inflation or non-inflation. Because when you do that average, you lose a lot of information. So what we do is to look episode by episode. And in the US, we identify 8 different inflation surges. And just to take a step back, an increase in inflation is not necessarily bad news. So if we start at, let's say, negative 1% and go to 2%, well, that could be very good news, because we start from a point that is potentially a depression or a recession, and the economy picks up and we get back to the 2%. So that's not necessarily bad, but it is bad historically if you go from, let's say, 2% and cross the 5% threshold. So those are the type of episodes that we have focused on. And what we do is look at different asset classes and also look at a number of active strategies, and then present episode by episode. And I think that's very valuable, because the inflation that we're about to experience or experiencing right now might be very different than the inflation in, let's say, the early 1970s. And maybe a better analogy would be the 1950s. So the reader can actually see all of the data. It's there. And you can see consistency also. So it might be that an asset does well only recently, but historically, if you go back, it doesn't do well. So you can actually see the consistency in our empirical analysis.
Yeah, as you say, there have been many episodes of inflation or heightened inflation, and I'm not sure that what we are going through right now would reach that threshold. As you said, 5%. Maybe that's I don't know where you got that particular threshold from. That seems a little bit arbitrary. Or with 6%, 7%? Do you want to clarify the backing to that 5% level?
Yeah, so there's a detailed analysis on our paper as to the rule. So just because you hit 5%, that does not qualify as a surge in our framework. It needs to be sustained above 5%. And we identify 8 episodes. We also do robustness to different rules. But you're correct that you need to make a choice. So this is part of empirical work. You need to make a choice as to how you define a surge. And that's just our choice. And we do our best.
You've got to set a threshold somewhere and a time length at which it's sustained for. So the fascinating bit here is you say that trend following provides the most reliable protection during important inflation shocks. So, and then you actually discuss cryptocurrencies. So what is trend following? Do you want to clarify how you use that term?
Yeah, so it's sometimes called time series momentum. Sometimes it's called CTA.
Momentum stocks. Yeah.
Yeah. So this is the idea that like a simple momentum rule would be if the past 12 months return on the asset is positive, then you're long. If the past 12 months is negative, then you're short. So it's a very simple system that's been around for decades, but it's got a very interesting property. And that is that as the asset price is going up, you're a buyer. And if you think about that in terms of derivatives, that's very similar to a dynamic replication of a call option. And if the price is going down, you're a seller. And that's very simple. Kind of a simple version of a dynamic replication of a put option. So this strategy is like a long put and a long call or a long straddle. And it's got positive convexity as a result of that. So in very bad times, it pays off. And in very good times, it pays off. So this is an attractive strategy, not just for inflation protection, but for drawdown protection too. And I've got another paper that deals with that.
I really want to drill down into that. Do you have a personal opinion as to why this momentum strategy has prevailed during inflationary times?
Yeah, again, I think it has to do with the fundamental mechanics, the theoretical mechanics of trend following, is that you're long a straddle. So if there's bad news, and we know in inflationary, we document this, that in inflationary periods, equities get hammered. And obviously fixed income is a loser in inflationary surges. Well, in these times, the trend following strategy, well, it's going to be short. And that's exactly what you want. You're getting paid off in these periods with this strategy. So it provides a natural protection that's theoretically motivated.
Yeah, and we discuss obviously precious metals and commodities, and you refer to that. Quote, commodities have positive returns during inflation surges, but there's considerable variation within the commodity complex. And then you say we provide analysis of alternative asset classes such as fine art, and you even discuss the economic rationale for including cryptocurrencies. Now, not many academics are willing to go out on a limb and actually defend holding cryptocurrencies with such incredible volatility. Since cryptocurrencies are so new, how do they play into this mix? I mean, because they were not around during these episodes. So you're saying the economic rationale, you're saying how they would fit into that mosaic.
Sure. So just to be clear, over the last 7 years, all of my teaching at Duke University is in the space of blockchain and crypto. So I've also got a book that's coming out in August called DeFi and the Future of Finance, where DeFi is decentralized finance. So we have to address crypto in our paper, and then it's a popular thing. And this is what we say. We say that exactly consistent with you, it's untested. And theoretically, the supply of something like Bitcoin is purely algorithmic. So it's not linked to any central bank. So theoretically, it should be uncoupled from what happens in the economy, which might be inflationary. But again, it's untested. And the little data that we've got, the quality data is really only from 2013, basically suggests that it is more connected than people think. So let's go back to March 2020, which was a disastrous month for markets. where the stock market plummets with the beginning of the COVID crisis. The market drops 30%. What about the traditional safe haven, gold? Well, no, it drops 22%. And what about cryptos? Theoretically, they're not linked to the economy. Bitcoin drops 55%.
Yeah.
So essentially, it's a risk asset, and so is gold. So gold's got the same volatility as the S&P 500. So if you're in a risk-off situation, the people are dumping their stocks, they're dumping their gold, and they're dumping their Bitcoin and piling into treasuries. And that's exactly what we saw. And then when risk on evolved and the crisis, we're going to get over it, we'll have vaccines eventually, the stock market skyrockets. Gold goes to its third highest price in all of history. And we know what happened to Bitcoin. So up 500%.
I have read, now correct me if I'm wrong, that the beta to Bitcoin has been rising steadily. So it's becoming, as you said, more and more coupled with other securities.
Yeah, it's a speculative asset. It's subject to risk on, risk off. We don't have a lot of data, but these important episodes suggest that there is beta. So to think that it's going to deliver inflation protection is naive in multiple dimensions. So it's naive because we don't have the history. It's untested. It's naive because, as you mentioned, the volatility. Like I've got a paper on gold where I argue that gold is not a reliable inflation hedge in the short term. It's a reliable inflation hedge over the extreme long term. We know gold's held its value historically. Well, Bitcoin is 6 times the volatility of gold. So it is just too volatile to be a reliable hedge for inflation.
Okay, well, let's just clarify though then. Given that situation, given what you've said about cryptocurrencies, what is the economic rationale for including them? You say because they do, when we go on the upside, they have tremendous momentum.
So
you said they're actually even more volatile than the rest of the market. So when we're going on the upside, they will carry more momentum forward.
So for a portfolio, and you're talking about a well-diversified portfolio,
of course,
volatility is not necessarily a bad thing. It's something that needs to be taken into account in terms of the optimization, the trade-off between your target return and your risk. But volatility is not necessarily a bad thing. But look, the crypto complex is worth 1.5 trillion right now. So we include things in our well-diversified portfolio like Apple, which has a $2 trillion capitalization. And I think it's a big mistake just to lump all the cryptos into the Bitcoin category. It's just not the case. The most interesting cryptos are linked to the Ethereum space. That's where all of the action is happening. And there's plenty of opportunities. And it's really hard to make the case that shouldn't be included in a well-diversified portfolio. How can you ignore something as large?
No, I fear I did not explain myself well enough there. And actually, I've written in favor of altcoins as having longer term, more viability than Bitcoin. But the point was just that, and I agree with you entirely that often volatility in a portfolio can actually be healthy with some elements countering others. But the point was just that during inflationary periods, is the almost high beta or volatility what makes cryptocurrencies attractive or would make them attractive? Like you said, we've only got about 7 or 8 years of data, but what was this economic rationale you discuss for including cryptocurrencies, particularly during inflationary periods?
So we actually don't advocate that cryptocurrencies are an inflation hedge. We only make the point that theoretically, they're decoupled from money supply and things like that. But in practice, they're just assets that have got like a positive beta. And you've got a positive beta against equities. If inflation surges, our analysis using 95 years of data suggests that equities get hammered. So you got a positive beta against equity, then I wouldn't be looking for a hedge from a crypto.
Almost everything is getting hammered, though, except how you say commodities have positive returns, but there's considerable variation. Do you want to discuss that variation? What performs better or worse? You said fixed income is problematic. I don't know how much that applies to the rental market, but do you want to clarify the disparities there within the commodities umbrella?
Sure. So commodities are like an asset class that just by construction, it's very diverse. So you've got things like gold and food and oil. So there's just naturally a large degree of variation. And you look at, for example, equities, different equity markets are all correlated. Like some of these commodities are not very highly correlated. So that's what we mean by the variation. If you construct a diversified commodity portfolio, I've got a paper that I published with Claude Herb in the Financial Analyst Journal that showed that commodities as a basket do provide some protection against unexpected inflation. This is important. What you want to hedge is the unexpected inflation, not expected inflation. Expected inflation is easy to basically capture. It's incorporated in bond yields. But we find that a diversified portfolio does fairly well, and that's of commodity futures. But we also do analysis of commodity by commodity. And it's obvious that some commodities are much more robust in terms of their inflation hedging ability than others. So it always seemed like an opportunity for me for some asset manager to actually construct a portfolio of commodities that's got the best possible shot in terms of hedging unexpected inflation. So again, all of these data are available in terms of my research, but in terms of asset classes, look, commodities are often like the cause of inflation. It's kind of obvious, right? So think of the OPEC shock and the 1970s, or actually two of them. And that was a big influence in terms, it wasn't the only thing, but it was a big influence. So in particular, energy commodities do very well. And you might think, well, energy is just not the same today as it was in the past because we've got electric vehicles. Well, we got electric vehicles, just not many of them. So if we're going to experience a surge over the next year, I believe that energies would be probably one of the things that you would look at.
Yeah, the basic logic, and I did read your Financial Times piece, which accompanied this, which is more for a popular audience, which just basically said that if commodities are driving inflation, presumably commodities are where the gains are. So it's not exactly complicated logic to follow there. So in some ways, this affirmed what common sense would tell you, although, as you said, there's a huge variety under that umbrella, so it's hard to be assertive about specifics there. Now, we've raced through the half hour. Campbell Harvey is a finance professor at Duke University. Follow him on LinkedIn, and we'll include a link to this full paper, the Financial Times piece, and I guess the Amazon profile for you so people can get the book when it's ready. Otherwise, Campbell, thank you for sharing your time. We appreciate it, and we'll continue to follow your work.
Thanks for inviting me.
Cheers.